Most people think they understand how financial markets work. They don't. And that misunderstanding costs them money. By the end of this episode, you'll understand something about markets that most traders never figure out, even after years of looking at charts. So, financial markets, any place people trade financial assets. The landscape is massive. Stocks, ownerships in companies, Apple, Tesla, Nvidia, bonds, lending money to governments or corporations. Sounds boring. It moves trillions. Commodities, physical goods, oil, gold, wheat, currencies. One currency against another, the largest market in the world. And futures, contracts based on the future price of any of the above. That's where we'll end up, but not yet. One distinction that changes everything. Trading is not investing. An investor buys and holds for months or years, betting the value will go up. A trader reads short-term price movements and profits from them, up or down, both directions, a different game. This series teaches you to trade. Every price in every market comes down to supply and demand. More buyers than sellers, price go up. More sellers than buyers, down. This is the mechanism. Every strategy you'll ever learn comes back to this. Prices rising over a sustained period of time, a bull market. Falling, a bear market. But who's creating that supply and demand? Think of a poker table. Institutions are the pros with massive stacks. Pension funds, hedge funds, sovereign wealth, they manage trillions. When institutions move, the markets move. Algorithms are bots playing thousands of hands per second. About 60 to 70% of all major market volume is automated. Market makers are the house, always willing to buy and sell. They profit from the spread. And retail traders, that's you, roughly 10 to 15% of volume. You'll hear people say banks manipulate markets to hunt retail stop losses. Think about what I just told you. Institutions managing trillions in pension aren't designing strategies around someone's $500 account. When your stop loss gets hit, your stop loss was poorly placed, not because Goldman Sachs targeted you personally. The market doesn't know you exist, and that's a good news. The playing field is based on skill, and that's exactly what this series builds. You know the arena. 5 markets, supply and demand as the engine. 4 types of participants, a playing field based on skill. Quick thing before we go deeper. Everything I'm about to show you, the economics, the forward pricing, the chain that connects it all, I put together a free reference kit so you can follow along and actually use this stuff after the episode. The Market Decoder Vault is the first link in the description. Grab it now. It'll make the next session hit a lot harder. Now, let me show you what all this looks like in the real world. On January 28, 2026, the Federal Reserve announced their interest rate decision. The Federal Reserve is the central bank of the United States. They control how expensive it is to borrow money across the entire economy. When the Fed changes that rate or even signals they might, every market on earth reacts. Stocks, bonds, currencies, commodities, everything. The S&P 500 was sitting around 7,000. That's the index tracking the 500 largest American companies. Basically the scoreboard of the US stock market. The decision hits, and the market barely moved, flat. The most powerful financial institution just made a decision that affects every person in every country. And nothing happened. Why? Because the market already knew. Weeks before the meeting, every institution, every algorithm, every professional trader had analyzed the data. Inflation is above target. Economy is growing. 3 rate cuts already done in 2025. The consensus was near universal. The Fed will hold. Futures market priced in close to 100% probability of no change. So when the Fed announced exactly what everyone expected, a hold at 3.5 to 375%, there was nothing to react to. The price already reflected the news. This is the most important thing you will learn about financial markets. Prices don't reflect what's happening right now. Prices reflect what everyone expects to happen next. Every trader, every fund manager, every algorithm, all doing the same thing, pricing the future. When the market crashes after bad news, The market didn't crash because of the news. The market crashed because the news was worse than what was already priced in. The gap between expectation and reality is where every dollar is made or lost. The January meeting wasn't completely uneventful. The vote was 10-2. 10 members voted to hold, but two governors, Stephen Myron and Christopher Waller, voted to cut. And in the meeting notes, some officials discussed whether rate hikes might actually be needed if inflation stays sticky. The Fed discussing cuts and hikes in the same meeting, that wasn't fully priced in. The headline move was zero, but underneath, the bonds yield ticked up. Rate expectations for March shifted. The market quietly repriced what might happen next. That repricing is what traders actually trade, not the headline, the shift in expectation, the gap. So now the question becomes, what creates those expectations? What makes market expect one thing and not another? Economics. And you need to understand exactly which parts move prices. The Fed controls one number that affects everything, the federal funds rate. The rate banks charges each other overnight. That single number cascades through the entire economy. When rates are low, businesses expand. Money flows into stocks because bonds pay almost nothing. When rates are high, borrowing is expensive. Money flows out of stocks and into bonds. Why take the risk when you can get 4 or 5% risk-free? But here's what most people miss. The Fed doesn't move markets by changing rates. The Fed moves markets by changing the expectations of future rates. That January meeting, rates stayed the same, but the distance and the hawkish language shifted what the market expects for March, for June, for the rest of the year. That shift moved money. Now, if the Fed controls interest rates, what controls the Fed? Inflation, the rate at which prices in the economy are rising. When your coffee goes from $3 to $3.50, that's inflation. The Fed target is 2% per year. Above that, the Fed keeps rates high to cool the economy. Below that, the Fed can cut and let the economy breathe. Two reports matter most: CPI, the Consumer Price Index, and PCE, Personal Consumption Expenditure. Released monthly, they are among the most watched number in the entire world. Here's the key. Traders don't trade inflation by itself. They trade the gap between expected and actual inflation. The market expects CPI at 3.2%. CPI comes in at 3.5. That 0.3% difference moves billions in minutes. Not because 3.5 is catastrophic, but because 3.5 is different from what was priced in. In the January FOMC statement, the Fed said inflation remains somewhat elevated. 7 words. To the market, those 7 words meant no rate cuts coming. That's how granular this gets. Now, here's where it gets counterintuitive. Every first Friday of the month, the Bureau of Labor Statistics releases the Non-Farm Payroll Report, NFP. How many jobs the economy added, unemployment, wage growth, a strong job report, more jobs, low employment, rising wages. That should be good news, right? It can crash the stock market. More people working, the economy growing, stocks drops. Why? Strong employment means the economy doesn't need help. The Fed has no reason to cut rates, and the stock market wants lower rates because lower rates means money flowing to the stocks. Good economic news, Fed stays restrictive, bad for stocks. Once you understand forward pricing, this makes perfect sense. The market isn't reacting to today's jobs. The market is repricing what the Fed will do next. Now, let me show you how all of this connects. GDP, the gross domestic product, the total output of the economy. Growing, slowing, contracting. Markets care about the direction and the surprise. GDP at 2.5 when everyone expects 2.5, no move. GDP at 2.5 when everyone expected 3, market reprices. Bonds. Most beginners skip bonds. That's a mistake. A bond is a loan to the government. In return, you get paid interest, the yield. When yields rise, the bonds becomes more attractive. Money flows out of stocks and into bonds. When yields fall, the opposite. Headlines that say bond yield spike, stock drops aren't random. That's capital flowing where the return is better. Geopolitics, wars, tariffs, sanctions, elections, these create uncertainty, and markets price uncertainty as risk. January 2026, US tariffs were running in the background. Fed economists noted tariffs add near-term inflation pressure. Geopolitics feeding into inflation, feeding into rates expectation, feeding into every asset price on earth. And earnings. Every quarter, companies report revenue, profit, and guidance. A company can report record profit and watch the stock drop because the market expected even more. Here's the full chain. Tariffs push inflation higher. Higher inflation keeps the Fed restrictive. A restrictive Fed keeps the bond yields elevated. Elevated yields pull capital from stocks. One chain. And every concept I just showed you was visible on the FOMC meeting on January 28. Once you see the chain, markets moves stop looking random because they never were. Everything I just taught you about economics and forward pricing, there's a tool that shows you exactly when the key data drops. The economic calendar. Every professional checks one before the market opens. TradingView has one built in. Trading Economics has an excellent one at tradingeconomics.com/calendar. And Financial Juice gives you real-time breaking news as it happens. These calendars show every upcoming report. CPI, NFP, FOMC meetings, GDP, rated by impact, high, medium, low. After this episode, you know what those events mean. You know why they move markets. And you know how to read the reaction through the lens of expectations versus reality. From our data on 20,000 traders, beginners who avoid trading during high-impact news events in their first month lose significantly less money. Not because news is bad, because news creates fast moves that beginners aren't equipped to navigate yet. Learn to read the calendar first, respect what those events represent. Two main ways to analyze the markets, and a third that develops over time. Fundamental analysis is everything we covered today. Reading the economics, what drives prices at the macro level. Technical analysis is reading the chart itself. Price patterns, market structure, support and resistance. This tells you where price is going based on what price is actually doing. Sentiment, the mood of the market. Fear, greed, positioning. You'll develop a feel for sentiment over time. The best traders use all three. For short-term trading, you'll start with technical analysis in episode 4. But the fundamental understanding you built today is the context that makes everything else work. Without fundamentals, you're reading charts in a vacuum. Before this episode, markets looked like noise. Random prices, news that made no sense. Now you see a system. You know what markets are. You know who's at the table. You understand supply and demand. You understand that prices reflect the future, not the present. And you know the gap between expectation and reality is where every dollar is made or lost. You can explain why a strong economy can crash a stock market. You can trace the chain from tariffs to inflation to interest rate to bond yields to equities. You have an economic calendar and you know how to read the reaction. From our data across 20,000 traders, most people trade for months, sometimes years, without understanding what you just learned in one episode. The ones who build this foundation first are the ones who last. You understand how markets work, you understand why prices move. One question left before you start learning to trade. Which market should you trade? Stocks, forex, crypto, futures. Different rules, different costs, different advantages, and one of them gives beginners a significantly bigger edge than the others. Episode 3 breaks down every option with real data. I'll show you exactly why one market stands out and why it gives beginners a structural edge no other can match. Probably not the market you'd guess. Subscribe, hit the bell. This series is designed to be watched in order. I'll see you in episode 3. Ciao.